Welcome to the daily update, where I'll go over the action in the market for Friday, December 22nd, and then we'll see how things look for Tuesday, December 26th. The market will be closed in observance of Christmas on Monday, so we have an extended holiday weekend. We had another up day, not a lot of volume. Volume is really dropping off as we're going more and more into holiday mode. We're still looking positive, but we're still looking overbought, both in the short and intermediate term. We have a lot of indicators that are giving us extreme positive readings. But until the market decides to pull back or at least chop sideways enough to wear off some of these conditions, we're going to keep going in this overextended to the upside type of condition. We'll have to see. Volume is likely to be very light between Christmas and New Year's. Sometimes, if a big player comes in, like a hedge fund or some kind of institution, and they do a lot of buying or selling, that can really whipsaw the market. Otherwise, we might see a lot of sideways action as folks are not focused as much on the market. They're enjoying the fact that 2023, it looks like it's going to be a very good year for the stock market, and they're focusing more on their families and on the holidays. So let's go back and talk about what happened. We had a higher open. The futures were positive during the night, and the economic reports that came out were taken as friendly. Prices climbed above R1 at 47.61, but we didn't get all the way up to R2 at 47.75. Not quite to that level. Then we fell back down to R1 and we chopped sideways along R1 for a while. Then we started to decline pretty much below R1 and we got down to the unchanged level. We actually went negative for a little bit and looked like, okay, here we go. We're going to see some selling. But we found support just a little bit above the daily pivot, which was at 47.35. And we closed slightly positive on the day. So we were up 0.17%, not really a gangbuster by any means, but still an up day on below average volume, which has become the norm and is probably going to be the norm for the next week or so. We are positive when we look at all of our charts together. So far, the economic reports that are coming out are friendly to this idea that we might have a soft landing, where we've been seeing economic weakness without going into a recession. Of course, that can always change if we start to get some really crazy economic reports that come out. But at least up to this point, the market is really liking what they see. We keep an eye on the geopolitical events that are happening because that can sometimes have an influence on either gold or oil or on the stock market itself. So some comments. We are in holiday mode now as volume is really dropping off, and the week between Christmas and New Year's tends to be fairly slow. The NASDAQ 100 did hit a new all-time high. The Dow did not. It was down slightly in Friday's session. Here's our short-term list with our ADX. That measures the condition of our trend. That is still extreme. It's starting to roll over. It's coming down just a little bit below its moving average, so it may be starting to weaken a little bit. It doesn't mean that we're necessarily changing trend. We use other charts to look at that. But this has been giving us such an extreme reading that it's starting to slow down. It's getting a little tired for the time being. We have a new addition to the list, the shorter term advanced decline ratio, as well as the 20-period exponential moving average, the Stochk RSI, the Williams percent R, just the CCI 20. The 14 is not there yet. The stochastics, the RSI based on 9 periods, the boom indicator based on 20 periods, and our PMO oscillator. Intermediate term, we're also looking quite extended and haven't quite rolled over yet with the ADX, and I'll show you all these charts. We have our 50-period exponential moving average study, the standard deviations chart, the Arun indicator, the PMO studies, the Sean trend meter, as well as the Chaikin money flow, the boom indicator based on 50 periods. So we have the short term in the 20 and the intermediate term with the 50. The balance of power is still extreme, as well as the RSI based on 14 periods. We have the bullish percent index for the S&P and NASDAQ 100, and our new high, new low study based on 10 periods for the S&P, as well as our more intermediate term study of the advanced decline ratio just based on price. Long term, we're still looking extreme with our longer term moving averages based on 150 and 200 periods. We're still dealing with the same scenario, and this is kind of the scenario going forward until we see something to come in and really change that the Fed is likely done raising rates and possibly getting to the point where they may start cutting rates. The market is anticipating that this could happen in March, but that is really open to change many times between now and then. The dollar was down and interest rates were up. We're at 3.9% now with the 10-year yield. We still have the 10 to the 2 and the 10 to the 3 month. Those yield curves are inverted. In fact, they're going more inverted all the time. Sentiment is still positive. We're at 74, where we had been at 72. And our trend is still positive because we had the up day. We're looking a little overextended there. And our bias is positive as well as our momentum being positive. So we have a whole list of economic reports to go through here. We had personal income. This is the other big inflation report that comes out. It was up 0.4% on a month-over-month basis, as expected, up from the 0.3% last month. Personal spending came in as expected, being up 0.2%. Last time it was up 0.1%. The PCE price index was down 0.1%. They expected it to be up 0.1%. On a year-over-year basis, it had been at 2.9%. Now it's gone down to 2.6%. So we're getting closer to that 2% target level that the Fed is trying to achieve. This is the big one, the core PCE price index. It was up 0.1% on a month-over-month basis. They had expected it to be up 0.2%. So that came in a little more friendly for inflation. On a year-over-year basis, we ticked down to 3.2%, where we had been at 3.4%. This was a strong report, and it can be influential at times. It came in a lot stronger than expected with the durable goods orders at 5.4% month over month, almost or more than double than the 2.5% they had expected. Last time it was down 5.1%. When you take out transportation, we were up 0.5%. They had expected it to be up 0.2%. Last time it was up 0.3%. And consumer sentiment came in at 69.7 as expected. The last time we had this reading, it was at 69.4. A year ago, it was at 59.8. So we're seeing a little bit of an improvement there. And then new home sales really took a dive. Apparently people were out celebrating Christmas early. But a lot of this probably had to do with, in the month of November, we saw interest rates really going up. And to get a mortgage was a lot more expensive than it would be even right now because interest rates have come back down. So new home sales were down 12.2% on a seasonal basis. That's 590,000 units. They expected 689,000 units. Last time we did get 672,000, and that was revised a little bit down from 679,000. Year over year, we're looking at 1.4% growth with new home sales. Here are some charts. Here's the personal income and spending. The income is the blue line, and it's positive, but it's been coming down slightly. Actually, the blue line is the spending. The yellow line is the income. When I record this, there's something that blocks the top part of this chart, and I can't see that, where we're seeing a decline in both of these. So from an inflation standpoint, this is more friendly. And this is the big one, the year-over-year inflation. When we look at the core inflation, it continues to decline, and the market really likes that. On a month-over-month basis, we did see a real drop-off in personal spending. And then durable goods orders did really tick up. They were a lot stronger than expected. And when you take out aircraft, so you're looking at non-defensive capital goods, we did tick up just slightly. And then when we look month over month, it really shot up. This is the highest reading that we've seen in quite some time. New home sales did tick down. This is the seasonally adjusted annual rate. So it did come down more than what they had anticipated. And then when we look at the year over year average, we're just really showing how this is really going down for new home sales. We did get consumer sentiment, which is seeing some improvement here. The blue line is the total, and that's ticking up slightly. The expectations looking out into the future, that's the yellow line. That's looking a little better. And the present conditions, how people are feeling right now, that's also showing some improvement. So looking at the intraday chart, we saw most of the gains right at the open. We gapped higher above R1, didn't quite make it up to R2 before coming back down and trailing along R1. We tried to go a little bit higher, but then we saw some selling come in that actually took us negative. Didn't quite get down to the daily pivot before we bounced and were able to close positive on the day. Here's the intraday chart where in the pre-market session, we did see some improvement. We saw most of the gains right at the open and then a lot of give back. And we closed pretty much flat going into the weekend, which will be extended by 1 day because of Christmas. We did see on this chart intraday where value did outperform growth. The red line is above the blue line, and we were down when we look at our growth to value ratio. This is another concern that we have. If the market was showing more strength, we would see growth outperforming value, and we would see the transports outperforming the Dow. And those are the two things that we're not seeing right now. Here's our end of day chart where growth was up, but a lot less than value. They were about even with the mid caps, and small cap growth actually outperformed small cap value slightly. Here's the chart that is causing a bit of a concern with our growth to value ratio for the S&P. It's not falling apart by any means, but it's not going up either. And we've been watching that one. Where mid-cap growth still continues to do quite well. It's actually breaking out above this range. Small cap growth's not doing all that great, but mid-cap growth is doing good. Here's our trend. This is the intermediate term chart where we're rolling over a little bit with the ADX, but we're still above the moving average. The green line dropped down below 40. It's still on top and it's going back up. So we have more of a positive stance that way, where we're starting to cross below the moving average with our short-term chart. And that usually happens before the intermediate term changes, but we're still leaning positive here. Again, this doesn't mean that we're going to see a reversal. This just means that the trend is showing some weakness. Looking at volume, we're really dropping down well below average there. Sentiment, we're also coming down with the VIX as we enter the latter part of December, where the Ulcer Index is showing there's just no fear in the market now. We tick down with the VIX with the line chart as well as the bar chart, and volatility of the VIX did decline. We're kind of right in between both moving averages, and we tend to do that on an up day. The VIX of the VIX tends to also decline as well as the VIX. This is a chart that we are keeping an eye on. It's the correlation between the VIX and the S&P. We're still getting a pretty high reading. We're not above this dashed line yet, but for 2 days now, we've been seeing this. And a lot of times this will mark some kind of a top in the market. So if we really spike up and then start to come down, that could be a concern. I do have the latest equity put call charts. We declined, which is kind of strange because it's a 3-day weekend before a holiday, but we didn't see a lot of extra hedging going on. So this ratio ended up going down. And on a 5-period basis, we're also turning back down slightly. So this is more positive for the market. We're still seeing an overall improvement with our risk on to risk off ratio, even though it declined slightly on Friday. Here's consumer sentiment, where we have the 2-year yield, which is coming down, and we're showing consumer sentiment getting a little better. So these are getting a bit closer to each other, but they're still quite far apart. Our advanced decline line study still looking pretty strong when we look at price and volume on this chart, even though price is outperforming volume right now. That's a little bit of a warning sign. We're flat with our 5-period and 10-period. When we look at the new highs, new lows, we did see more new highs. We didn't really see any new lows being generated for the S&P, but this has been trailing off lately. And here's the advanced decline ratio based on 19 periods. That's the blue line. We're starting to get extreme. We're not extreme with the red line, which is based on 39 periods. The accumulation distribution is still looking strong. We're also wondering, are we getting kind of far away from this moving average? The check and money flow also still positive, but we're getting kind of an extreme reading. We did see an improvement with the cumulative NYSE advanced decline line with the up day, and our regular advanced decline line is coming back up to this previous level. We're wondering if we can break out above that. And we're also coming back to this previous level with our other NYSE advanced decline line. And when we're also seeing a bit of a negative divergence here. When we look at the NYSE common stock advanced decline line, we're breaking out based on price, but we're not breaking out based on volume. A week or so ago, we were seeing just the opposite of that, and that led to higher prices. We're wondering if price is getting a little bit ahead of itself right now. But when we look at our advanced decline line studies, we're still looking good with the NYSE, S&P, mid caps, and even the small caps are improving. Here's our daily chart where we're still looking fairly positive. We haven't really come down and tested this pivot point yet. We're holding up even after the decline. We're starting to claw our way back, but we haven't exceeded the high that we set earlier on. We're looking extreme with the 20 and 50 period moving average study. We're just below looking extreme with the 200 period moving average study. And here's our usual suspects. The Williams percent R is extreme positive. The CCI 20 is declining, but it's still above 100. The force index did tick down just a little bit, and it's below its midpoint. It's not as strong as we would like it to be, but it's still positive. And we're still extreme in the short term with our stochastics, coming down, but still extreme in the intermediate term. We're starting to come down as well in the long short term, but we're still extreme. And we're still in the +3 standard deviation here. We were actually outside of that. And the fact that we're up into this area just shows that we're going up pretty far, pretty fast. We're also looking extreme with our boom indicator. This measures how far away are we from different moving averages. We're getting a little far away from the 20 period and the 50 period. We're still showing some improvement with the 200 period. Some intermediate term charts. We are declining with the balance of power, but we're still extreme positive. When we look at a trend based on the go, no-go system, we're still seeing the darker blue bars, which are positive. And we're still at the higher end here with our highest high value and above the midpoint. That's still hanging in there. The TTM squeeze is also going back up, and we have a lighter shade of blue. And we're turning back up with the ease of movement, and we're above 0. That's positive. We're still looking rather extreme with the Arun. The green line is on top, even though it's declining, but the red line is also declining, still giving us a pretty extreme positive reading. And we continue to go up with the summation index based on price, but we're flat to declining based on volume. Another potential warning sign. But we continue to go up with our NYSE summation index based on price and volume. We're starting to break out above this previous level based on price. We have not broken out yet based on volume. And we're still looking at our 50-period double and triple exponential moving averages because this seems to be providing support as this line continues to go up. We did turn back up with the Swenlin trading oscillator. We had been pointing down. The fact that this turned back up is more positive based on price and volume, and we're above 0 with both. And we're still extreme with the PMO, the price momentum oscillator. We're above the moving average. But when you look down here, we're starting to show some weakness with price as we're just barely starting to cross below the moving average based on volume. Sometimes these readings give us a heads up as to what will happen with the PMO itself. We're not extreme with the PMOs that are rising. We're declining after being extreme with the buy signals. We're turning down, but we're still extreme with the PMOs above 0. We continue to be neutral with the Elder's Impulse system for the S&P. We continue to be positive with the parabolic SAR. The slope oscillator continues to go up and is giving us an extreme reading. The MACD is still above its moving average, but also it's potentially giving us an extreme reading. So with all of our oscillators, we're positive across the board, but we're looking extreme in the short term. We're starting to roll over a bit with the TSI. The MACD is close, but hasn't crossed below its moving average yet. We're still looking good with the PPO and the PMO. The PMO and the PPO, I get this mixed up a little bit. But we're still positive with our longer-term oscillators, the TRIX and the KST. And we're still well above all of the plotted moving averages here. And we're still extreme positive with the bullish percent index for the S&P. We're still looking positive with the NYSE bullish percent index. And we're kind of flattening out, but getting a very, very high reading with the NASDAQ 100 bullish percent index. The Sean trend meter has gone sideways a bit, but is still extreme positive. We're still extreme, even though we're coming back down with the Chaikin oscillator. The money flow index did turn back up and is above 50. That's positive. And we're starting to decline with the ultimate oscillator, but we're still above 50. The vortex shows that the green line is going up. That's positive. And the Copic curve continues to be positive. We're starting to get extreme again with our RSI 14 as well as the RSI 9. On balance volume is still positive. And we're still getting to really high readings with our 200 period moving average study. And we're getting to very high readings in the 90% range with our 50 period moving average study. I don't have any Fibonacci and line studies now because we're in no man's land as far as that's concerned. So we look at the condition of our trend. The Heikin Ashi is switching back and looking more positive now. The Kegi chart, which had been pointing down, is now pointing back up. The Renko chart, which never did turn negative, continues to be positive, and we're still showing a dark bar here with the 3-line break. Long-term charts. We're getting extreme and staying extreme with our 150 and 200 period moving average study. And we're still above this longer-term trend line with the weekly chart of the S&P. That's still positive. And we're coming right up to the trend line now with the NASDAQ 100. These are long-term critical areas. We want to see if we can break above that, or are we going to end up falling down below them? The equal weight index still is holding up quite well and performing about the same as the S&P 500. We didn't see much of a change in our ratio here. And as this goes down, that just means more of the broad market is outperforming the mega caps. But this is another concern where even though we were down with the Dow, we have already broken out here. We have not come back to this previous high with the transports. We were up slightly with the utilities. And this negative divergence is a little bit of a concern. We're seeing that in this chart where the red line is underneath the black line, showing that the transports are underperforming the Dow. The Dow is down just a little bit, and it's been starting to chop sideways now. The diamonds continue to be neutral. We're still hanging in there with the NASDAQ. We haven't really come back to test this pivot level yet, but we haven't broken out to a new short-term high either. And the NASDAQ 100, kind of the same thing. We haven't not back down to this pivot point. We haven't broken out yet to a new high. The Qs still remain neutral for the Elders Impulse system. Our momentum is still positive. It's rolling over just a little bit, but it's still above its moving average for the NASDAQ 100. And we did set another new all-time high with the NASDAQ when we measure it by using the QQQs. The small caps were up almost 0.5%, but we really haven't broken above these previous bars yet. And we're above both of these moving averages. If we can stay up here, we might see a golden cross. Here's the Russell 2000 small caps getting extreme with the RSI. We're still above this resistance level, which you could now call support. We're showing some improvement with our longer term trend, and the momentum in the shorter term continues to be positive. However, we still remain neutral with the Elders Impulse system for the small caps. The mid caps are kind of chopping sideways and getting closer to the top end of their shorter term range. We could be getting ready to see a golden cross here, but we still remain neutral for the mid caps when we look at the Elders Impulse system. We were up 0.21% with the financial sector. It's been showing a lot of improvement and continues to be in an uptrend. The micro caps were up over 1%, up into the 115 range, just under 116. The FANG index did not set any kind of a high. It was actually down 0.33%. And we're not coming back to this previous all-time high yet, but so far, price seems to be holding up. And we did see a bit of a decline with the dollar, even though we're in a longer-term uptrend. Shorter term, we've been seeing some weakness. When we look at bonds, we were up just a little bit with the 10-year yield, down just a little bit based on price. We're still getting a positive result when we take the 1-month yield and subtract the 3-month yield, which is strange. We should not be getting that. And we've been seeing this for quite a while now, and that's a little bit of a concern. So looking at our growth to value ratio charts, the Qs are still holding up when compared to the S&P. We turned down just a little bit, but we're still above the moving average when we look at discretionary to the S&P. Large cap growth is really having a difficult time now outperforming large cap value. So with the large caps, we're seeing a little bit of weakness coming down to the moving average. We're seeing some strength in the mid caps and just a teeny tiny little bit of strength with this measurement of the small caps. We're still extreme positive with our 10-day average of the S&P 500 highs minus the lows. We've been up here now for quite a while. And we're still above zero with our broader market range look at the highs minus the lows, taking a 5-period moving average. We continue to go up with our new highs, new lows based on 50 periods for the S&P. And we're starting to get extreme with the mid caps. We're breaking above this 90% level with our 50-period moving average study. We're also breaking above 90% with the small caps as well. We're breaking above this extreme reading here based on price when we look at the 19-day exponential moving average of the advanced decline ratio, but we're not extreme based on volume. The S&P to utilities ratio is going back up, which gives support to the S&P. The 2-year yield is coming down, which gives support to the S&P, and the Staples to S&P 500 ratio continues to decline, which also gives support to the S&P. So what's our outlook for Tuesday? We will be in holiday mode. Volume is really dropping off, and also be reminded that the market will be closed on Monday for Christmas. We did get earnings that came out in Friday's session. That was Nike. That was kind of a big draining factor. It wasn't well received. We are positive still, but continue to be overbought. We'll get, okay, and I didn't change this. We're not going to get really much of anything. I'll show you on the next chart here. So, and then we also keep an eye on the geopolitical events. Here's the economic calendar, where on Tuesday, we're going to get FHFA housing price. That index will come out, as well as the Case-Shiller home price. We're not going to get any economic reports on Wednesday, at least that I could see. Usually we get the weekly mortgages, but I didn't see that on the calendar. And then we're going to get pending home sales on Thursday, and then get Chicago PMI. So it's not a huge day, a huge week as far as economic reports are concerned, but we kind of take all of these together. Seasonally, we are positive for the 26th, where for the Dow and S&P, we're up 71.4% of the time. The NASDAQ is up 66.7% of the time. We're no longer in the week after options expiration. We are wondering if the January effect is going to continue, where small caps outperform the large caps. And we do see some positive seasonality on the 17th trading day of the month. We see the green dashed line going up. And we also see potentially some positive action here with the Carson chart. But we will be in Tuesday's session, where that tends to be one of the down days in 2023. And then looking at our seasonal charts, we're looking positive across the board until we get later into the end of the year. This chart is also looking positive, as is this chart, and the election versus non-election chart, and the Carson chart. And even the equity clock chart still shows that we're looking pretty positive seasonally. And when we look at the Stock Traders Almanac for the NASDAQ, that's positive. And for the S&P, that is also positive. And then we're still trying to figure out, are we going to see more of a parallel from 1982 to what we've been seeing in 2023? That led to some really good things after that. We're wondering if something like that's going to happen this time. So our scenarios, we're not going with the down one, even though we are overbought. It's hard to go with the up one right now because we are so overbought, but still, that is the bias of the market for right now. And that's what our charts are suggesting. We are still extreme with our trend, even though we're starting to see the short term dropping below its moving average. Not an awful lot of warning signs right now, but the warning signs that we are getting are pretty big. Growth is not participating in this upward move, at least very much. And the transports are diverging in a negative way from the Dow. Those are two pretty big things. We're still in overall downtrends with the Russell small caps and mid caps, but if we stay above those moving averages, that could change soon. We have a pretty long list of positive things, including the daily special K chart, the equity put call chart based on 5 periods. It's starting to go back down, as is the longer term chart that we look at. We were down slightly with our risk on to risk off posture, but we are showing longer term improvement there. Our oscillators are positive, but some of them are getting really extreme now. The parabolic SAR and the vortex are positive. The bullish percent index for the S&P is extreme positive. The Kopit curve is positive. The Zohorchak method, we haven't seen a change there recently. It had been negative. Now it's ticked back up to neutral. Small and mid-cap growth is positive, especially the mid-caps, where the small caps are lagging behind. But overall, they continue to chop more or less sideways, with the mid-caps doing a little bit better. The financial sector is showing a lot of improvement, and our longer-term 50-period exponential moving average study of the new highs, new lows continues to be positive. So our conclusion, for right now, I'm not saying blow off top or pull back or anything like that, because we're coming into a holiday week. We're just going with what we see things happening as they are right now. We're positive, but we are overbought. And we say that in the short and intermediate term, as well as the long term. We're just slightly overbought in the long term. So thank you. I want to wish all of you a very Merry Christmas. And I hope you have a great holiday weekend. And I will be putting out the weekly video, the intermarket analysis video, and the deep dive video. I might be a little bit late with those because of family obligations and different things going on in my life, but I'll get those posted just as soon as possible. So I will talk to you in the next video.